Hello, welcome to Roadmap to Wealth. My name is Carlos McWhorter, CPA, and today I want to talk to you about a very simple financial rule that people discuss or talk about called the Rule of 72. I'm also going to take it a little step further and talk about what I believe is the best application of using the rules. So first I'm going to explain it, then we'll get into the application. So the Rule of 72 is used by people to determine how fast it will take for your money to double in an investment, depending on the interest rate. So basically you take 72, you divide it by your expected or the interest rate that you hope to return on your investment, and whatever that equation equals, that is the length of time that it will take for your investment to double. And so if you were to invest your money and you receive the average market returns of 10%, that means it would take 7.2 years for your money to double in the stock market. So if you were to invest very successfully or perhaps put that money into real estate and your cash flow is at a rate of about 15% a year, 72 divided by 15, 4.8 years. 5% increase, you're looking at 4.8 years for your money to double based on that investment. Now, if it was an 8% return on that investment, 9 years for your money to double in the market. So the Rule of 72, looking at this illustration, shows you based on the hoped or anticipated return on your investment, there's going to be a significant difference on how long it takes for your money to double. So this is a good exercise and a good thing to think about when you are investing. But I believe the best application of the Rule of 72 is not how long it would take for money to double, but how long will it take for the value of money to halve. Now we think about this when it comes to retirement. So we often think about how much money we need for retirement, and we typically think in terms of today. It's kind of hard to determine what things will cost in the future, what our cost of living is going to be in the future. We understand 20 years ago, things were a whole lot cheaper, but we fail to think that 20 years from now, things are going to be a whole lot more expensive. So we have to factor that in when we're thinking about how much money we need for retirement. So let's just say, for example, you say you need $2 million to retire comfortably. If you have 2 million, you're good, you can retire. Many times when we come up with a number, we're thinking about today's terms. So let's think about in the future. If you are, say my age, if you're 40 years old and you think all you need is $2 million, you have about 20 years, let's just say 20. So at 60, you plan on retiring. What is that $2 million going to be worth in 20 years? And I think this is the rule we need to use to figure that out. So here we go. We have someone who's 40 years old. They're going to retire at 60. So it gives them 20 more years to build up their retirement and 20 years for inflation to have an impact on how much we have or what our buying power is going to be. So over the past 60 years, inflation has averaged at about 3.72% a year. So the cost of goods goes up about 3.72% per year on average over the past 60 years. So it's safe to use this rate in this calculation. So if we take 72 and divide that by 3.72%, we end up with 19.3. So based on looking at the future, we have 19.3 years before the value of our money halves as far as buying power. So $2 million today is going to be worth $1 million in the future in 19.3 years. So if you're 40 years old and you think you need $2 million to retire, thinking about today, you probably need to plan on having about $4 million to retire at that same lifestyle that you're thinking about. Let's say you're 30 years old and you still are thinking about that $2 million. Let's use the same numbers, the same formula, and see how that impacts someone who's at 30 years. They're 30, they're planning on retiring at 60 years old. So they have 30 years before they retire. So again, that's 30 years to build up your retirement fund. That's also 30 years for inflation to eat away at the value of money. So let's look at it. 30 years to retirement, 30 years old, retire at 60. So let's use that same formula looking at 30 years to retire. You have 30 years to retire, and let's just say, instead of 3.72, let's use 4%. Let's round it up. The Rule of 72 says at 4%, money will double or halve if we're thinking about inflation in 18 years. So 30 divided by 18 is 1.6. So this money is going to halve in 30 years at a rate of 1.6 times. So what does that mean if you think you need $2 million to retire and you're 30 years old right now? So if you have $2 million divided by that 1.6, that means $2 million today is going to be worth what we see as $750,000 30 years from now. So the purpose of this video is to give you some tools to use and some things to think about when you're thinking about retirement. At my age and in my careers, I've seen many people work longer than they desire to because they didn't account for the increase in cost. They didn't invest enough to make up for the impact of inflation and the loss of buying power. So as you're putting away money and investing and looking at different investment vehicles, think about the rule of 72 and how long it would take for your money to double. So also think about the rule of 72 to think about inflation and its impact on your retirement funds. Thank you for joining me. I hope this video was helpful. If it was, consider hitting the like button and subscribing to my channel. I have so much more coming for you. I'll see you in the next video.